Welcome back to the Crypto Intellect, the channel where we cut through the noise, follow the data, and uncover what is really happening behind the scenes in the crypto market. Today's story is one that has shocked even some of the most experienced XRP watchers. According to recent on-chain data, wallets holding massive amounts of XRP now control roughly 74% of the entire circulating supply. Think about that for a moment. Nearly 3/4 of all available XRP is sitting inside the hands of a relatively small group of giant holders. Even more surprising is what happened while many retail investors were losing interest, growing frustrated, or moving on to other projects. During the same period, these large wallets continued accumulating at an aggressive pace, quietly adding billions of dollars worth of XRP to their holdings. While social media focused on memes, hype cycles, and short-term price swings, some of the biggest players in the XRP ecosystem appeared to be doing the exact opposite. They were accumulating. The question is simple but incredibly important. What do these whales see that many smaller investors might be missing right now? One of the biggest mistakes people make in crypto is assuming that price tells the whole story. Price is only one piece of the puzzle. Behind every chart are investors, institutions, funds, and market participants making decisions every single day. When we examine the XRP market through that lens, the story becomes far more interesting. While XRP spent long stretches moving sideways and testing the patience of holders, the largest wallets on the network were steadily growing larger. This is not the type of behavior you typically see from investors who believe an asset has no future. Large-scale accumulation usually signals confidence, patience, and a long-term thesis. That does not automatically guarantee higher prices tomorrow, next week, or even next month. However, it does suggest that some of the most capitalized participants in the ecosystem believe the current environment offers opportunity rather than danger. When billion-dollar players continue buying while retail sentiment remains weak, it deserves attention. It may not provide certainty, but it certainly provides a clue worth investigating. Before we go deeper, it is important to stay grounded. Whenever we discuss whales, institutional money, and potential future price movements, emotions can quickly take over. Some viewers immediately become extremely bullish. Others become skeptical and assume there must be manipulation involved. The truth is usually somewhere in the middle. On-chain data is useful because it shows what wallets are doing, but it does not tell us exactly why they are doing it. A whale can accumulate for months and still decide to sell later. An institution can build a position and then change its strategy based on economic conditions. Nothing in the market is guaranteed. That is why the goal today is not to create hype or fear. The goal is to understand the facts. The fact is that concentration among large XRP holders has increased significantly. The fact is that these wallets have accumulated substantial amounts during a period when many smaller investors were losing confidence. Understanding what that means could help explain some of the most important developments happening in the XRP ecosystem right now. Let's break down that 74% number because it is truly the centerpiece of this discussion. On-chain analysts often categorize wallets by the amount of XRP they hold. When those categories are analyzed, wallets containing 1 million XRP or more collectively account for around 74% of the circulating supply. That is a staggering figure. Imagine a company where a small group of shareholders owned nearly 3/4 of all available shares. Their actions would matter tremendously. The same principle applies here. Large holders have a significant influence on supply dynamics, market liquidity, and investor psychology. What makes the statistic even more fascinating is that it is not merely a snapshot frozen in time. Over recent months, those large wallets have reportedly continued adding to their positions. In other words, the concentration is not simply remaining high. In many cases, it is becoming even more pronounced. That trend has sparked intense debate throughout the crypto community because it forces everyone to ask the same question. Are whales preparing for something larger down the road? To understand why accumulation matters, we need to talk about supply. Every market is ultimately driven by supply and demand. When a significant percentage of an asset is held by investors who are not actively selling, the available trading supply becomes smaller. Analysts often refer to this as a reduction in float. The lower the float, the more sensitive an asset can become when new demand enters the market. Imagine a small store with only a few products left on the shelf. If suddenly a crowd of customers arrives wanting to buy those products, prices can rise quickly because supply is limited. The same concept applies to digital assets. If large XRP holders continue locking away significant amounts of supply while demand increases through adoption, institutional interest, or market momentum, the result can be powerful upward pressure. This does not guarantee a price explosion, but it helps explain why experienced investors pay close attention to accumulation patterns. They understand that supply constraints often become visible before major price moves rather than after them. Many investors focus exclusively on headlines, but smart money often focuses on positioning. History across financial markets shows that large investors frequently accumulate during periods of uncertainty. They do not usually wait until every headline becomes positive. By the time the public becomes overwhelmingly bullish, much of the positioning has already occurred. That is why whale activity attracts so much attention. If major XRP holders are adding to their positions while sentiment remains mixed, they may be viewing current conditions as favorable. Again, this does not mean they possess secret information. It may simply reflect a longer investment horizon. Large investors typically think in terms of years rather than days. They are less concerned with short-term volatility and more focused on long-term trends. When viewed from that perspective, the recent accumulation trend becomes difficult to ignore. It suggests that some sophisticated market participants believe the XRP story may be stronger than current market sentiment implies. However, there is another side to this story, and it is extremely important that we discuss it honestly. Concentration is not automatically bullish. In fact, it introduces a very real risk. The same whales who can reduce supply by holding their XRP can also increase supply by selling it. A market with concentrated ownership can become vulnerable if major holders decide to take profits or rebalance their portfolios. Because so much XRP is held by a relatively small number of wallets, their actions can influence price movements more dramatically than those of ordinary investors. This is why experienced analysts always view whale accumulation through a balanced lens. It can be a positive signal, but it can also create volatility. Markets rarely move in a straight line, and large holders are not charitable organizations. Their objective is to generate returns. Sometimes that means buying. Other times it means selling. Understanding both possibilities is essential if you want to interpret the data responsibly. Another detail often overlooked in discussions about whale ownership is that not every large wallet belongs to an individual investor or institution. Some of these addresses belong to exchanges. Exchange wallets frequently hold XRP on behalf of thousands or even millions of customers. As a result, the headline figure of 74% can sometimes create a misleading impression if interpreted too literally. The concentration is still significant, but not every large wallet represents a single whale making deliberate investment decisions. Some represent pooled customer funds. That distinction matters because exchange-related activity may be driven by customer deposits, withdrawals, trading demand, or operational requirements rather than long-term conviction. Even so, the broader accumulation trend remains noteworthy because analysts have observed growth among categories of large holders beyond exchange wallets as well. The key takeaway is not to oversimplify the data. The market is complex, and understanding that complexity helps separate meaningful analysis from sensational headlines. One of the most fascinating aspects of this entire situation is the contrast between whale behavior and retail behavior. It often feels like two completely different worlds operating at the same time. Retail investors tend to experience every market move emotionally. They watch charts constantly. They celebrate green candles and panic during red ones. Large investors often operate differently. They expect volatility. They plan for it. They understand that fear and uncertainty are natural parts of every market cycle. As a result, they may view periods of weakness as opportunities rather than threats. This difference in mindset can create dramatically different outcomes over time. While retail participants react to market conditions, larger investors frequently position themselves ahead of them. That does not make whales smarter in every situation, but it does highlight the importance of strategy. Emotional decision-making often produces inconsistent results, whereas disciplined investing tends to reward patience. What makes this trend even more interesting is that it is happening during a period when XRP's broader ecosystem continues evolving. The conversation around blockchain technology has changed dramatically over the past few years. Early crypto cycles were heavily driven by speculation, hype, and promises of revolutionary innovation. Today, institutions are increasingly focused on practical use cases. They want efficiency, compliance, reliability, and infrastructure capable of supporting real-world financial activity. XRP and the XRP Ledger have positioned themselves within that conversation for years. Whether discussing cross-border payments, settlement solutions, tokenization, or institutional finance, XRP remains part of many industry discussions. As traditional financial institutions continue exploring blockchain technology, projects with established infrastructure may become increasingly relevant. This broader context helps explain why some investors remain optimistic despite periods of slow price performance. A growing area of interest across the financial world is tokenization. Financial institutions are exploring ways to bring traditional assets onto blockchain networks. Treasury products, credit instruments, funds, and other real-world assets are increasingly becoming part of this conversation. Supporters of XRP argue that the XRP Ledger is well-positioned to participate in that trend due to its speed, efficiency, and focus on enterprise-grade functionality. If tokenization continues expanding over the coming years, networks capable of supporting large-scale financial activity could benefit significantly. This does not mean success is guaranteed. Competition remains intense. Numerous blockchain ecosystems are pursuing similar opportunities. Nevertheless, the growing focus on real-world utility provides an important backdrop when evaluating whale accumulation. Large investors may not simply be buying a token. They may be investing in a broader vision of where blockchain technology could be heading over the next decade. Another development attracting attention is the increasing emphasis on stablecoins and regulated digital assets. Financial institutions generally prefer predictable and compliant systems over speculative environments. As blockchain adoption matures, the industry appears to be moving toward greater integration with traditional finance rather than complete separation from it. XRP supporters often point to this trend as evidence that the ecosystem's long-term strategy aligns with institutional needs. Faster settlement, lower costs, and around-the-clock availability are features that appeal to businesses and financial organizations. If these advantages continue gaining recognition, demand for infrastructure supporting those activities could increase. Whether XRP ultimately captures a significant share of that opportunity remains uncertain, but it helps explain why some investors remain focused on long-term fundamentals rather than short-term price fluctuations. Of course, whenever discussions about accumulation emerge, the next question is always about price. Investors naturally want to know what all of this could mean for XRP's future valuation. The honest answer is that nobody knows. Price targets can be entertaining, but they should never be mistaken for guarantees. Markets are influenced by countless variables, including regulation, adoption, macroeconomic conditions, competition, investor sentiment, and technological development. Some analysts envision substantial upside over the coming years. Others remain cautious. What matters most is understanding the factors driving those projections. Whale accumulation, shrinking available supply, institutional interest, and ecosystem growth are all pieces of a larger puzzle. None of them guarantee a specific outcome individually. Together, however, they create a framework that investors can use when evaluating XRP's long-term potential. Perhaps the most important lesson from today's discussion is that successful investing often requires looking beyond headlines. Headlines tend to focus on dramatic predictions, emotional reactions, and short-term price action. The deeper story is usually found in the data. Right now, the data suggests that large XRP holders have been accumulating while many retail participants have been stepping away. Whether that proves to be a brilliant move or a costly mistake will only become clear with time. What we can say is that the trend exists, it is measurable, and it deserves serious attention. Markets often reward those willing to study underlying fundamentals rather than simply reacting to daily noise. That principle applies not only to XRP but to virtually every asset class. As we bring everything together, the picture becomes much clearer. Approximately 74% of circulating XRP is now controlled by large wallets, and many of those wallets have continued accumulating despite uncertain market conditions. That is a significant development. It suggests confidence among major holders and highlights the possibility of tightening supply dynamics. At the same time, concentration introduces risks, including the potential for volatility if large holders decide to sell. The reality is neither purely bullish nor purely bearish. It is a nuanced story requiring careful analysis. What makes it so compelling is that it forces investors to think beyond surface-level narratives and examine the actual behavior occurring on the blockchain. Sometimes the most important signals are not the loudest ones. Sometimes they are the quiet movements happening behind the scenes while everyone else is looking elsewhere. And that is why this may be one of the most important XRP stories of the year. While social media debates continue and price predictions dominate headlines, the real story may be unfolding in the wallets of the network's largest participants. Whether these whales are positioning for institutional adoption, future utility growth, expanding tokenization opportunities, or something else entirely remains open to interpretation. What is not open to interpretation is the data itself. Large holders have been accumulating, supply concentration remains high, and the market is paying attention. As always, stay informed, stay patient, do your own research, and focus on the facts rather than the noise. Thank you for watching the Crypto Intellect. If you enjoyed today's breakdown, make sure to like the video, subscribe to the channel, and turn on notifications so you never miss the latest XRP news. Until next time, stay smart, stay curious, and keep your eyes on the data.